is up, Zinger Nation? Welcome back to another episode of Benzinga Live. Happy Tuesday, everybody. Ryan, how are you doing today?
Good. How you doing, Aaron?
Good. It's good to have you back, man. It's been a couple weeks.
Yeah, it has. I mean, I had a break, and then you had a break, and there was Future Proof thrown in there, so it's good to be back into the routine.
Yeah, it really is. So before we get started, we were talking a little bit before the show. Sounded like, you had a good weekend. You got to get out on the water. That's always good.
It is. I mean, I lived in Barbados for 6 years, and I am happiest on, in, or under the water. Even really cold water like we have in Switzerland, I'll take it. Just whatever you got, I'm in it.
How cold is it? Is it like you need a wetsuit if you want to get in the water? Can you swim without a wetsuit?
It depends on your tolerance. Like coming here from Barbados, I feel like I need a dry suit to get in this lake. But the locals are like, they're in there in a Speedo, man. Like, I mean,
really?
And they'll swim in that in February. I'm not joking. It'll be like 5 degrees, and they will be swimming in that thing in February. You know, I would be in like, I don't know. Yeah, like a dry suit, probably.
Yeah, I mean, I know a lot of people kind of sing the praises of the cold plunge and taking cold showers, and I feel like it's become a very, very common advice among like the Huberman Lab, podcast crowd and like the tech crowd. But that's just one thing I have not gotten behind yet. Maybe I need to give it a try, but can't do the super cold water, especially. Like,
you got to give it a shot, man. I mean, I was skeptical through the whole summer. You know, I moved to the Caribbean originally because I hate the cold, despite being a Canadian. And, I started with the contrast therapy, the hot tub, cold plunge. And man, like I got into it. I got seriously into it. It's how I start every day. Now it's like 10 minutes in the hot tub and 5 minutes or sauna and 5 minutes in the cold plunge back and forth. And I am like on fire. Sounds terrible, but it's actually pretty cool. You got to try it first before you hate on it.
All right. Well, if you've tried it and you're telling me I got to try it, then that means I actually got to try it. So I will, Ryan, and I'll report back. I don't know. I guess I could just like do a cold shower. I don't really have a way to do it.
That's awful. Don't do that. Don't do the cold shower. It's like on the back of your neck. It's like drizzling down your back. It's just the plunge is like 10 horrible seconds, and then you're good. You're just sitting there,
Okay.
All zen.
I don't have access to a. Maybe I could just hop in the pool at the gym, like go straight from the hot tub to the pool and back. Maybe that would kind of simulate the same thing, but it wouldn't be cold enough. I don't think so.
No, you just got to. Well, maybe it would be. Maybe it would be to start. You got to try.
Okay. I will. All right. Well, let's get into it, Ryan. So I kind of teased, Kaiju again. There may be some people joining us today who this is their first time, and they've missed out on a lot. They've missed out on a lot of good information that we've talked about the past few times. But for maybe some of those people, you want to just give the quick elevator 30-second pitch on what Kaiju is, what you guys do.
Sure. So for those who don't know us, we're a global ecosystem of companies. We use artificial intelligence to build trading intellectual property, trading strategies. And then if the strategies are possible to be used in a 40 Act space, so that's public dissemination, we wrap them up as ETFs and we launch them that way. And if they're not, we use them in private funds that we manage on the private fund side. So everything starts with Kaiju IP. We build everything in-house. We've been doing this for like over half a decade, long before it was in the mainstream news cycle, that is for sure, and long enough to have been made fun of for it, which I keep saying probably should stop. And that's it. Yeah, when our flagship ETF launched last December, it was the first fully curated and directed AI ETF. We launched on the New York Stock Exchange, moved down to the New York Stock Exchange floor in March, only one of 6 ETFs on the NYSE floor. And it's been good so far. And, we saw some pretty huge flows in like the last couple of days, which was nice to see after a successful future proof. So many thanks to those RIAs who came on board after long discussions.
Well, there you go. I'm glad the conference was productive. So Ryan, I'm glad you were able to give a brief overview there, because my first question today is about the team. And I'm sure, we've talked about this, how, at Kaiju, you guys have been using AI and kind of in this technology for a while. It's not like, there's a lot of firms that are now saying, oh, we use AI because they saw it get hot, but you guys have been doing this for a while. And your team is comprised of experts from a very diverse backgrounds, applied mathematics, theoretical physics and cosmology, enterprise technology, and in your case, cryptography. So how do all these, having people from all these different areas work together? How is that a strength for Kaiju?
Well, I think there are a couple of different ways to look at why that's advantageous. Because of course, someone might think, you're coming from these diverse backgrounds, like how do you get on the same page? Like you're sort of clearly not from the same discipline, and there's some overlap. I mean, maths are part of everything that all of us do, but where's that intersection and why is it beneficial? Number one, I would say none of us were incubated in a financial space originally. I mean, I was an equities trader eventually after I was a cryptographer, and then a portfolio manager and a CIO fund manager before I, became the CEO of Global Kaiju. But I didn't start there. I didn't come out of school and like right onto the NYSE floor or the Merck or SIBO or whatever it was. And the same with everyone else who works here. And so we don't tend to look at problems the way that people who've been incubated in those environments look at problems. I mean, that's a systemic issue, right? When you have, like, you take the Tiger Cubs, for example, you have a couple of standouts there, but you've had some lackluster performance, and you sort of wonder why. And and it's because there's a central ideology that they're all exposed to and they're all using. They're branching out slightly. It's really hard to do something unique when it's been bashed into your head over and over again. And we're all susceptible to that. So when you have somebody coming from a completely different discipline, especially one that uses AI in a way in which you haven't used it before. I mean, we've all used AI before. We came together in our own disciplines, but not in the same way. There are commonalities for sure. We're solving different problems in novel ways. So that's a huge strength. Like, I learn from the team all the time, every day. Hopefully they learn from me. I mean, one of the fun things that we do every quarter is I fly up to London, which is where the sort of core AI team is. And we talk about trading mechanics, and that's where we solve all of the mechanical problems that, exist when you're bringing a model strategy into the real world. It's like, great, works super in a validated model environment, and it's absolutely possible. Now let's see how this works real world. And that can be, a collision sometimes. Like, the machine's telling you to sell 1,400 spreads of like ISRG, and the counterparty's like, yeah, I don't want that. And the data scientist is like, what do you mean you don't want that? The machine thinks, yeah, that's the Theo value. You should be able to sell that. And you're like, yeah, he's just in a bad mood today. Sorry. And that has to be quantified and fed back into the machine. So, coming at it from different perspectives help us work through those problems.
Yeah, I find that fascinating. I was wondering if it's, one of those things where it's almost like hard to get everyone on the same page because everyone's coming from these different backgrounds and might not see things the exact same way. But at the end of the day, I think, as in nature, right? Like in an environment, you want diversity, you want different things working together. And I could see how that could also, be a strength for Kaiju. One thing about for the DIP ETF, and a while ago, Ryan, this may have seemed like a hypothetical question, but how would the ETF prepare for a black swan event? I mean, the COVID-19 crash, we actually saw a black swan event, which, those don't come around too often. I think that's the definition of a black swan event, is they don't come around too often.
Yeah, exactly. And if you haven't designed the ETF specifically just to predate on black swan events, then just like a human portfolio manager, there's risk there. I mean, I would love to be able to build a system that, made a lot of money in normal market conditions, and then, hey, like miraculously identified a black swan event, flipped the entire portfolio construction, and then made money when it collapsed or surged or whatever it is. But if I did that, I'd be on a very large yacht somewhere and probably not doing this show. As much as I love it, though, Aaron. But what we do with black swan event prediction is, we run these two engines at the broad market level, sector and industry level, and the discrete underlying level. And the two engines are regime classification and regime change detection. And so classification at any level we're running it at, and if you've done the math, there are like hundreds to thousands of classification engines running from like Disney and Netflix all the way up to, sector, industry, and then broad market. And classification is just trying to say, okay, based on what I'm seeing in the moment, real time at the tick level, what regime do I think I'm in? And it's bull bear neutral, or I don't know. And that matches up with decisions that it's going to make. So let's take an example. So I just mentioned Disney. We'll use Disney, fine. So it identifies that Disney is, suddenly shifted from neutral to bear, from bull to bear. It's going to talk with the sector and industry classification engines. Is this like a sector and industry thing? Is it a broad market thing? Or is it just Disney? And that will help the machine make decisions at those different levels. Is it taking like broad protection, or is it like, oh, well, that thing's just tanking over there, I guess we should manage that and move on to something else? And then we have change detection. Change detection is looking at the information that's coming in at the tick level. And instead of, historically, where do I think I am? It's based on what I'm seeing in the moment. What do I think is coming next? Is it a continuation? I'm neutral. I'm going to continue neutral. I'm neutral and I'm bull. Neutral, it's going to bear. And there's a percent probability that it guesses it has in terms of predictive capacity with that. So the most interesting for us, of course, is I don't know. And that's the black swan event, right? And when it kicks back a whole series of I don't knows, it means that in 220 terabytes of tick level data, it's never seen this before, ever. It has no reasonable correlation with any pattern that's existed in any market anywhere. And that'll give you some pause, right? If you look at what would it have said as the market started to heave off the cliff after Feb 2020, you mentioned COVID. So that was I don't know what this is. And what it at least allows you to do is take protective action. Right? You're not just hitting your same favorite strategies the whole way down. Yeah, baby, this is going to turn around. Let's go. You're going to say, okay, obviously we're not going to try and corridor anything when it's collapsing through the floor. You're getting exchange circuit breakers that are tripping. You're getting global halts. You're getting that's a whoa, hold on. And it's one of the reasons that, especially in the DIP ETF prospectus and in private fund prospectuses, you have to say stuff like, or we may hold cash in certain circumstances. Nobody wants their money not to work. There's no trading strategy where it's like, yeah, I'm not going to put this money to work. But you identify that if you have one of these moments, I don't think anyone wants you to pretend that nothing's happening and you just keep going. So,
well,
yeah.
I was kind of curious about that. Would there almost a number, not that the AI would be trained to do this, but could there ever be a case where, say there's like a flash crash and something's going on and the AI on its own wants to just sell everything? Because at least I would figure that wouldn't be actually the worst, break glass in case of emergency. If there is some sort of crazy event happening and the AI doesn't recognize exactly what's going on, I feel like that wouldn't be in all the realm of things it could do. It wouldn't be the worst thing in the world.
Yeah, no, and it depends what you program it to do. If you're predating on specific signals, they basically disappear and you get hit with an across the board, I don't know, return from all of these engines, 690 different engines or 2,200 engines, depending on which sphere you're looking at, suddenly all fire off, I don't know. What it'll do is it'll look to mitigate risk, close positions, and then it's going to wait until it does have a reasonable degree of certainty. And it doesn't take very long for it to do that. I mean, the regional banking collapse for us was something the machine had never seen before in the US in March. So, there's a collapse, markets go down, dip traded lower than its benchmark did. But then it took like 2 days for it to identify what it was and said, oh, I got this. Unfortunately, at the time, we had sort of partner constraints that prevented us from doing 100% rebalance. That changed as of like 3 weeks ago. So we can just rebalance completely. But, we have this historical information that at that moment, it certainly wanted to. It wanted to dump the entire portfolio and reload with what it identified was going to be profitable. So, but you have to tell it to do that. If you don't tell it to do that, sometimes these things can just freeze. And that comes down to like, I'm going to be boring and be like a broken record here, but that's the responsible AI, right? That you and I have talked about before. What's the difference between just, painting with the AI paintbrush and the responsible AI?
Yeah, I guess, and that makes sense. I guess I could just foresee a scenario in which we're talking about a like black swan event where if the algorithms are kind of getting these, I don't know, signals. And like you said, it might not take it that long to figure out, what to do or what's going on. But like you'd want it to act quickly, I'd assume. You don't want to have that like inaction that could, so I guess it'll just be interesting to see over time how these AI things like deal with these events. Because, I mean, going back to COVID, I don't think like when you hear how a lot of professional traders and investors, like a lot of them had never seen a market respond the way to COVID, and especially coming out of COVID, like the recovery when the market recovered, like a lot of people were like, we've never seen anything like this. So with different AI algorithms, the way they're trained by things that they've seen before, I could imagine it'll be like, I'm just curious to see how it's going to work, going through something for the very first time.
I mean, it's seen a pandemic now, right? I mean, like it's at least got one reference point, but, when you say, a lot of investors or traders, I mean, none of us had ever traded through a pandemic before, right? The last traders that have done so are like freaking dead. So, that was.
But specifically, just not, pandemic or not, I think just like that the crash at first of all in March 2020, but then that rapid recovery from that V-shaped recovery, how quickly like the S&P, and then the like specifically there were days I remember looking back on it, like I think there was a day the NASDAQ closed up 7% or something crazy on the day, and they were like, professional traders that weren't bad traders or dumb people that were like, maybe shorting a little bit because they were going, okay, this is getting out of hand, the economy is closed, and the next thing they knew, they wake up the next morning, the market's up another 4%. So I mean, I think it was just a crazy time. So I could see, I don't know how much, I mean, obviously there was a lot of quant trading and algorithmic trading going on at the time, which some of it was probably doing really well and some of it probably wasn't doing well. But I wonder now, with the way AI technology has progressed, even in like 3 years, how AI would have been dealing with those types of movements back then. That would have been interesting to see.
It's not, I don't want to make a statement that AI is substantially predictive, because it can help us try to identify what we think we're seeing with a little more certainty. There's not a crystal ball. It can't be a crystal ball. But, one of the reasons that we did well in that collapse is that we were fully set up net long units short side for that collapse. Now, we did not know it was a pandemic, like no freaking idea that this was coming. We just in that week before the collapse, we were getting a lot of I don't knows, like constantly. And after a 2-month melt up, you look at the news cycle, and this bug is starting to make its way around the world, and it's starting to command more and more space. So what's the safe thing to do? Be net long south side. So, you don't know why you're doing it, but you know that that's the move to make in this particular circumstance. And then when the collapse came, you're like 30-cent spreads are blowing up to like $25. March is great for us. And so it can do that. It can do that. To your point though, the non-dead cat bounce that came afterwards and like the rocket upwards. Yeah, I had like safety nets, another 20 points down, and I don't think anyone thought we were going straight back up to a new all-time high in the next 4 weeks. Like it was not a money.
Yeah, and I mean, I especially too, once the market had recovered, say like most of the way back to where it was, and then it was like, okay, we're like basically back to where we were, but the economy's still closed. Cases
like,
look like cases are rising. Yeah, exactly. Like how it's not going to keep going up, and then a bunch. Yeah, and then so I don't know. I mean, it was like we said, just a I don't know. At the time, it was big to say it was unprecedented. It truly was unprecedented, but now it's not. Now we've been through it, like you said. Now the AI's got that in the bank, but it'll be interesting because like the next time there's an event like that, it'll it's like history.
Market will react like that next time.
Right, history doesn't repeat itself, but it rhymes. So there may be like things that are similar to the COVID crash, but might not be the exact same. One thing that I've always been like shocked at looking back on the COVID crash is, and I feel like this is kind of shows that even with how advanced trading is and how smart, or maybe not smart, a lot of people on Wall Street are, I don't know, but that it's still, the market is still not completely efficient, is that looking back on the COVID crash and why the market crashed, and I know hindsight is 2020, but the fact that stocks like Amazon and stuff even dipped at all, let alone like 20% on the onset, when the whole reason the market was crashing was, okay, people are this disease. I just feel like it was weird. People didn't have that foresight to be like, well, if the market's crashing, who's going to benefit? It's going to be Amazon because everyone's going to be at home staying away from this disease. But I could, hindsight's 2020.
Hindsight, like you didn't know that.
It was the uncertainty aspect.
You were going to be at home. Were you going to be at home on a respirator? I don't think you were ordering anything from Amazon if that was the case. What if the controls and restrictions were like, well, I'm sorry, but food deliveries only, and fine. So grocery gateway or Whole Foods at home or whatever the hell it is, they would benefit. Zoom certainly went on a tear, right? But, in those early days, you just, it was this really happening? Is this the zombie apocalypse? Like people just didn't know what services were going to be interrupted and then for how long. Like, are you getting paid? And, you could boil it all down, that crazy reversal to a preponderance of sports bettors in the world, no sports, and $1.2 trillion of stimulus money that went to a lot of people who didn't actually need it. So you get your $1,200 and you're like, sweet, I'm still getting paid. I'm going to gamble this on Tesla. I'm going to pump this into the stock market. There's no football, so I'm just going. And that's like, you see the result.
Yeah, I will say personally, I was in the crowd of people who like was making more money during COVID, because I never like stopped working. I was working at a golf course in college when COVID first hit, or I was not in college. I was done with school, but still in my college town where I went to school and working at a golf course. So we was like working outside, never stopped working, not like a single day. And I still got stimulus checks. So I was still getting my paycheck. And then on top of that, so yeah, I'm definitely in that crowd of someone who was getting more money, didn't have any sports or anything to gamble on. So was in the markets a little more than probably I would have been. But now I'm here and it all worked out. So,
give you a new career.
Exactly. So Ryan, Marco Argenti, I hope I'm saying his name right, the chief information officer at Goldman Sachs, recently said in an interview that there are two camps right now in AI. The first is that AI helps you do things that you do today, but faster and better. And then the other camp is saying that AI helps you do things that you're just not capable of as a human being. Which to me, I don't think those two things necessarily have to be mutually exclusive, I guess. But what camp would you say you were in if you did have to pick one or the other?
I would pick the not mutually exclusive camp for sure. They really are just not mutually exclusive. There are all kinds of things that AI is going to make a lot easier. Generative AI already does that to a large extent. It's going to be better. Imagine being able to use generative AI and say, okay, so go look up 13Ds where insiders have increased their position to more than X right before large moves have occurred. Find out the insiders who have done that prior to the most positive large moves. Then give me a list of those insiders who have done that in the last quarter. like that would take you forever to look all that up. You have a research team of analysts, but you could probably do that within like 15 minutes using appropriate prompts with generative AI and access to those materials. So that's something you're still going to make the decision at the end of the day. But the AI is going to really help you cut the time from that. And then, on the flip side, things that, humans can't do. Yeah, before we rebalance dip every day, that AI conducts 2 billion discrete examinations. Like, I can't do that. I don't know anyone that can do that. And I mean, like, we don't trade in a nanosecond time frame, but we absolutely analyze in that time scale. So, that's I'm supposed to say regulators require, I say may exceed human capabilities, but I mean, come on. There's stuff like that. The AI that flies your plane through insane hurricane turbulence is going to be able to do that with more agility than a human pilot, because it's able to interpret the data at a vastly superior scale. That said, do you really want to just fly in a plane where there's no person there, just in case this thing decides to not show up for work that day? There's a short. No, the entire aircrew is there to save your freaking life. So, it's a balance, but there are directions where it'll go both ways, but there are some that'll be, really attractive early on. Oh, have you seen the original art it can create? And then you'll find it generally soulless, and that part of it will die out because that's something that humans do really well.
Yeah, exactly. Yeah, and exactly. That's, I think, my point too, in saying that it's not, I think there are things that it can do faster, but in that same route, like that speed itself is something that we can't do. So yeah, I can analyze 100 different stocks for me in 2 minutes. I can do that technically. It would take me a lot longer than 2 minutes though. Well, Ryan, so let's we've gone a little bit over time today, but it's been a great conversation. So I'm glad. I just don't want to keep you too long because I know you're a busy guy.
With us, Aaron. We ramble sometimes. Sorry, folks.
Hey, it's all good. It's like we've got our own AI almost.
Yeah, and it goes in circles. It's like I'd take that one back to the lab, frankly.
Let's go to our Kaiju kicker, and let's talk about exchange traded products today. So, we know about ETFs, exchange traded funds, but let's talk about ETPs, exchange traded products. What are the most important things retail traders should know about ETPs before they consider trading them? What are the key benefits of trading ETPs, and what are the biggest dangers?
Okay, that's a lot to unpack. Let me see if I can do this in like 3 minutes. Okay, so what should ETPs? That's everything. That's ETFs, ETNs, and a variety of other structured products. What is it that people should know before they trade them? I think the one thing that I don't see a lot in the retail space is an analysis of what the core goal of the ETP is. So when these things came along originally, right, they weren't, ETFs just weren't constructed for retail traders. They were institutional hedging instruments. So they were packaged together to serve a specific hedge need against a human constructed portfolio. That's how so I want to hedge off my tech risk. I'm going to use the Qs. I want to hedge my AI or my chip risk. I'm going to use SMH, right? Like in the sector ETFs, it was a way where if a sector was getting hit and you had to make a very agile intraday decision, you could pump capital into positive or inverse ETFs with a specific construction to, instead of discretely hedging all of these individual positions. Like, our vol art portfolio can have like 290 discrete positions. If that all had to be hedged individually, like there's no way our traders, awesome as they are, could handle all of that. And so you have these products which are like, cool, I will use 12 of these and that'll sort my whole book out really, really fast. The problem is if you don't understand what these things are designed to do, and you're literally just trading price action, then you're going to get whipped here and there by something that you didn't understand. I hate to admit that I did this when I was a professional trader, but occasionally we would predate on retail using some of these ETPs where they didn't know what the product was for. There were a pair of natural gas derivatives. They were ETNs, so exchange traded notes. They were Credit Suisse's 20-year forward-looking natural gas bonds. But we became aware of the fact that most of the traders who are retail that were active in this thought it was natural gas. They thought it was a natural gas proxy. And so you'd read in these Yahoo chats stuff like, oh, I think it's going to be a cold winter. I'm going to buy more of this. And we sort of looked at it and went, holy shit, these guys have no idea what this is or why the swings were crazy. Well, the swings were crazy. They were like, they would open up or down like 30%, 17%. So you could make a killing if you were directionally right on the close to open, which is how we traded them because we were aware of how the bonds were going to be priced. So it was a little unfair, but God, buyer beware in these conditions, right? So understand that triple leveraged gold bull or whatever it is, you think has this sexy price action. Understand how it moves and what its interdependencies are, right? How many components are in these things? You have like a short component list in tech. You have overweight in, NVIDIA and Apple, and they both sell off. It's going to take that ETF with it. There's nothing wrong with the ETF. It's just overweighted in a couple of areas. So it's really important to understand what the purpose of this thing is before you trade it. I think that might have covered everything. the pros, cons, risks, whatever.
I mean, there you go, guys. I mean, if that's not like kind of some inside baseball, some behind the scenes stuff, pulling the curtain back, if you will, then I don't know what is. It's some great insights for us, Ryan. Thank you for sharing with us with us today. But yeah, man, great conversation as always. It's great to have you back on the show, Ryan. And yeah, folks, if you guys want more, where can they find you?
Global Kaiju is kaiju.ai. The ETF part of what we do is Kaiju ETF Advisors. And if you're interested specifically in DIP, you can just go to dipetf.com. I think that covers everything for now.
Beautiful. Dropping those links in the chat, y'all. If you guys want to go check that out, check out the DIP ETF, ticker DIP. Ryan Pannell, as always, thank you for joining us on Benzinga Live. Enjoy the rest of your Tuesday.
Aaron. Always a pleasure. Have a good one.